Morning, market chameleons, and happy Monday morning. And there's the King Chameleon about to appear, Dmitry. Morning, D.
Good morning, Will. How are you?
Listen, before we get started, everyone, Dmitry is doing a credit put spread webinar tomorrow on Interactive Brokers platform. So we'll be doing that tomorrow night. I put a link. D. Morning, market chameleons, and happy Monday morning. And there's the King Chameleon about to appear. Sorry about that. Technical issues. Double YouTube. Let's get the disclaimer up, D.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do or just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help, excuse me, answer your questions, provide you with guidance. There's the disclaimer, everyone.
Excellent. So the registration for the webinar is in the chat for anyone who wants to sign up for tomorrow's webinar.
Yep, and this is the first time we're doing it with Interactive Brokers. And I think what we're going to do is, if it's good, it's successful, maybe we'll do a webinar once a month with the community on Interactive Brokers. And of course, you know, everybody from our community is welcome to watch it. We're going to send out an email, and I'm going to start out doing it with vertical spreads, credit put spreads. But what I'll do is, just since we're doing it tomorrow, I might just go through a screen today and do a little bit of this. Way it helps me refresh things, and if there are questions along the way, it will be helpful to me for tomorrow's webinar. So that's what I think we'll do. We'll go over the pre-market report, and I'm going to go to the screeners, and we're going to screen out some credit put spreads today.
Cool.
Sound good?
Yep.
All right. Let me share my screen real quick. And I'll tell you, before it gets started, you know how we've been talking about inflation, Will, along the way, and how a lot of times we hear people talking about inflation, saying it's coming forward because interest rates are low, or Fed's printing too much money. But I think you start now seeing it, right? We've been hearing it from companies. We heard it from Warren Buffett. We've heard it from Procter and Gamble, from Kimberly-Clark, and even the headline news. And you're starting to see corn prices going up, and used cars. There's a shortage of used cars. You're ordering things online. There are delays, and I don't know how people are feeling, but even if you go out to restaurants or go to buy food, everywhere you're starting to see really like prices starting to accelerate. Are you feeling that, Will? Is that like in real time?
My situation. We just got this place at the shore that we're trying. It's a real fixer-upper. I mean, if you price lumber, anything, building materials, you try to call someone to do some work, there is, no one's answering your calls. And if someone answers, they're like, you're paying through the nose for anything right now. So no, inflation's everywhere. Actually, I read an article today that diaper prices are through the roof. I guess they're blaming it on the power outage in Texas. I guess one of the chemicals is made around Houston that go into the absorption in the diapers. And now there's some sort of shortage. And of course, the price of diapers, I guess, are through the roof right now. So
it's really starting to be, pervasive throughout the entire economy. It's not just concentrated. It's really like spread out all over, and you just feel the sense. And I'm mentioning it because maybe going forward, we'll start to talk about more ways, to protect your wealth, how do you, you have a storage of wealth, you have savings, you have investments. What do you do in that type of situation? Because at least for now, it seems to me, if you listen to Powell, if you listen to the Fed, they're going to have a tolerance for they're kind of redefining it, but they're going to have a high tolerance to keep interest rates super low. And also they're going to let, I think, inflation kind of they're not going to get ahead of it. They're going to start just following behind it. And in a way, maybe they've determined that it's a necessity for us we have to kind of inflate out of some of our debt, right? Maybe we're not left with that many choices, but I think going forward, we're kind of already hitting up against it, and we'll, start talking about, well, what are ways, or what are things you could do, to protect yourself against inflation, if you believe that will be a problem going forward. So for now, though, let's stay with our daily routine. We'll look at what's moving in the pre-market hours, and then we're going to go to the screener, look at vertical spreads. And if you have any questions, Will, let me know. I'm going to try to answer as many questions as I can before the end of the show.
Will do.
All right, so this is pre-market report, stocks that are trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to take a look. Well, before I use the filter, I see 116 made the percentage gainers list, 45 on the percentage decliners list. From that perspective, looks more like a bullish bias at the opening. I'm going to then use this filter to see what's going on in the higher market cap stocks. So let's take a look at market cap 20 billion or higher. So we got here 28 made the percentage gainers list, 15 on the decliners list. So slightly bullish at the open, but almost neutral. Some of these at the top, I see BNTX. We see a little E there, means that it reported earnings either today before the market opened or the previous day after the market closed. So that's reacting to earnings up 7.6%, 198,000 shares trading in the pre-market hours. Here on the sell side, also this is reacting to an earnings report today before the market closed. TTD down 11.9% on 63,000 shares in the pre-market hours. Just eyeballing it really quickly, I don't see really big volumes here. They're all kind of in the thousands, maybe a couple 100,000 veil, but nothing sticking out at me right now. And to save time, unless you have questions, I'll take some questions. If not, I'm going to move on to the credit put spread screen.
Sounds good.
Okay, so let's take a look at screeners here. And since I'm going to do the webinar tomorrow on vertical spreads, particularly credit put spreads, I'm going to use this screener today. And right here, this guy, bull put spread. We're going to take a look, do an example screen, go over some of the data elements in this table. And this will help me. If you guys have questions, let me know, because if you have questions, most likely other people have the same questions. They might not be asking it, but they're thinking the same thing. And I'm going to try to incorporate that into the webinar tomorrow. So here, the screener, we got these are the data elements below in the table, and we got different views. So if you tab them, you have different views of different data. I'm going to stay on the summary. Up top, we have filters to narrow down the candidates, and that's what we're going to be using, the filters. And you could see I could tab through it, which shows additional filters to this table. Now, if hopefully people know what a selling a put spread is, but when you're selling a put spread, you're selling a put on one strike, buying a put below. So you're receiving a credit. You're selling a put that should be priced higher than the one you're buying because you're selling a higher strike. When you receive that, you receive a credit for it, and your bias is basically, it's going to be a bullish bias, or depending which strikes you sell, you could have a neutral outlook. Maybe you think that the stock is really going to sit there and you will be able to collect that premium. So the stock may not increase in price before expiration, but that will be okay. If you have an out of the money put spread, you'll still collect that premium, and those options will decay to parity. So we'll take a look at that. Similar to, instead of selling a naked put, a lot of people just selling out of the money put, trying to collect that premium. A put spread could have a similar idea, except you're buying protection. So this way, if a stock crashes and you're wrong, you don't end up, you limit your risk, right? You don't end up holding that put all the way down because you stop yourself out at some strike. Let's, before I start the screen up top, I'm going to just kind of go over down here what these data elements are, and then I'm going to start screening. So up top here, there are two defaults on the screener. One is it defaults to an expiration, so defaults to monthly the next monthly expiration, and we could change that. So let me just change that right away, and I'm going to say just look for any expiration next 30 days. So it's not going to just look at one expiration, but any expiration that will expire within the next 30 days. So it populated 95,000 candidates right now, 95,266. Yeah.
We have a new chameleon on, Danny, and he's asking, how is the logic for the credit put spread detail defined? So maybe while you go through each one, you let him know exactly where the data is coming from. He's obviously new to the credit put spread screener.
Okay.
All
so, right. So when you're I mean, I'm not exactly sure what the question is, how the detail is defined. I'm not sure what that means exactly. Maybe you could just expand on that question. But what it will do is look through different stocks and combinations of put spreads. But there are certain limitations, certain thresholds it has to meet. So it's not going to look for doing put spreads with very wide markets that would be too expensive or maybe too ridiculous to even consider. So there are things in there that look at the liquidity of the options. Also, we limit the distance between strikes. So that's the next default here, where here it's set to a maximum of $5 between strikes. You could change that, but it's auto set to a maximum of 5. Now, when you scan the markets, there are almost a limitless amount. There's a limit, but a very large amount of different combinations you could do. Markets are moving around. You could look at dollar spread, $half, $3, $5. You could go on and on and on, which becomes very intensive. Not just because we're not only screening for the prices, we're doing analytics on it. So you have to try to limit it so this way you could process it in a manner that's not going to take you 5 hours to process through. Again, so we look at conditions of liquidity and we limit the distance between the strike prices. Does that help answer his question?
Yeah, that's helpful. Now, when would you look? Jake mentioned, Jake says he wants to know the logic behind it. You take one out when you have a new, he's asking when, I guess Jake is asking or saying that he's probably asking when you'd put on this position. And Jake is saying neutral to bullish positions on the underlying. So if you're neutral to bullish, this would be the best time.
Yeah, exactly. If you're neutral to bullish, and I'll try to get to a payout diagram to kind of show you what it looks like, but it depends on what strikes you're doing. If you're doing certain strikes, then you could have a very bullish outlook, almost similar like buying an out of the money call if you're doing out of the money, or if you're doing strikes that are below the current price, they're out of the money, below the current price, then you're probably just neutral. You just want the stock to kind of sit there or hover around, but you want the stock price, like here, Apple, to finish above the strike price that you're short, right? So here in Apple, I'm just going to kind of go over here. Here are the different spreads that we're screening out. So here you got June 4th expiration. You're selling the 142 put, buying the 137 put, and you're getting a credit of $4.30. And now, your best scenario is if the stock is above 142 at expiration, because if it's above 142 in this scenario, above your short strike, both these puts expire worthless. They're out of the money. The stock's 143, 144, 145. Stock's out of the money. Both puts expire worthless, and whatever you sold it for. And here we see at $4.30. You just get to keep it, right? Because those options are done. So in this case, you see this is a pretty bullish outlook because the stock has to increase by a lot. It has to go above 142. If you do different strikes, then you could have a more neutral outlook. Like if you're doing strikes below 130, like 120, 125, for example. So I'll show an example of that, but hopefully that kind of helps answer the question. So we got Apple, stock 130, market cap 2.2 trillion. Since I didn't do any filtering yet, it just kind of pops up. It's going to show all Apple because this is sorted by market cap right now. So that's why we're seeing a bunch of Apple. There's no filters yet, except for next 30 days. Here, this is the first put spread it filtered out June 4th, 142. So on the 142 put, buying the 137 put for $4.30. Now, one of the things we do is compare, well, how does this $4.30 compare to a theoretical value? So we go and generate a theoretical value based on historical stock behavior in Apple. So we take other things into consideration, the implied volatility, if there's earnings or no earnings. I don't have enough time to go through the whole details of it, but we have a bunch of videos here on theoretical value. And here you have a benchmark. So we think it's theoretically worth $3.35. So if you're selling it above there, right, you want to sell above, buy below. If you're selling, in this case, we're selling above the theoretical value, that's like theoretical edge. So in this case, like 95 cents above our theoretical value. That gives us a 135% theoretical edge if we convert it to percentage terms. Why? Because if we have a 95-cent edge, what's our risk on this? If we sell it, right, I'm sorry, our risk is, we're selling it for $4.30. Our risk is 70 cents because at expiration, if the stock's below 137, we have to buy back for $5, right? If we're buying it back for $5, we sold it for $4.30, we're risking 70 cents. But we got an extra edge when we sold it. So basically, if in the long term, if we think of it as it's worth $3.35 and we're selling it for $4.30 based on our risk, it's like 135% edge if the behavior continues theoretically. Does that make sense to everybody? Hopefully.
No question. So I'm assuming it makes sense.
All right. And historically, if you sold it for $4.30, 47.1% of the time, it would have been profitable given the same circumstances we're looking at today. Days to expiration, strikes same distance away from spot price, implied volatility levels, near the same levels and so forth. Historically, 47.1% of the time, it was a winner. Okay. We got the max loss here. What about the downside cushion here? So downside cushion, I'm going to use a filter, and it's here, cushion to break even. So I'm going to use this and put like at least 2% to show an example what that means. And now it's going to reload, rescan all the markets and give us anything that has a 2% downside cushion or more. So we see here, Apple, $130.23. We're selling the May 128 put, buying the 126 put. Just to recap, this is 56-cent credit. We think theoretically it's worth 27 cents. That's a 19.8% theoretical edge. Historical probability of success, 83.3%. What does this downside cushion mean? 2.1%. So we see stocks 130.23. As long as the stock remains above 128, which it is already, but at expiration, As long as the stock's above 128, we keep this entire credit 56 cents. Since we received 56 cents, it can fall a little bit below 128 by as much as 56 cents before we break even. Below that, we start losing. So in other words, if the stock just stays here or goes higher, of course, that's great for us. We keep that credit. But we got an extra 2.1% that it could go against, in the opposite direction. In other words, it could go down before we, to a break even, before we start losing. So it's kind of a little bit of cushion to the downside. Does everybody get that?
Yep,
right,
they're getting it.
Okay. What about the return? So we know May 28th, we're at May 10th. I don't know how many days that's trading days until expiration, maybe 11, something like that. So at expiration, May 28th, what would our return be if the stock just sat here or went higher, right? So here, if it just remained here, 130.23, went higher, or really it has to be above 128, what would our return be? Because, we know how much, we just talked about how much we're risking, but what do we think, what would we make on it based on the risk we're taking? So if we're taking $1.44 risk, what would our return be? So here, 38.9%. So as long as the stock kind of sits here, Apple, goes higher, stays above 128, we will make a 38.9% return on what we risked. So here it is. We risk $1.44, right? Because if Apple falls below 126 at expiration, this put spread, we got to buy back for $2. We sold it for 56 cents. So there's $1.44. We lose that. How much do we stand to make? Well, if Apple is above 128, we keep the entire 56 cents. So if we keep 56 cents and risk $1.44, it's a 38.9% return in the next 2 weeks, as long as that scenario plays out. The stock's above 128. So everybody okay with that?
Looking good.
All right. So I could even set a minimum there, return it flat, let's say. And I'm just using these as examples. So let's say we need 10%. And this would be a little bit more of a conservative looking, because, a more bullish outlook would be the opposite. You won't get any return if flat, but your return at the end of expiration would be greater, if you took on more risk. So I'm doing return it flat 10%. We want a theoretical edge, so I'm going to start using some of these just to speed it up a little bit. So obviously, if we don't, unless we're very sure about something happening, a stock going up, and if you're not, could go, you want to take a look for theoretical edge, because that's a little bit extra, right? We're not sure. It could go up, it could go down, but a theoretical edge is like you're getting paid a little bit extra to take on that risk. So let's take a look at theoretical edge, and I'm going to put it at least 5%. So now it's going to keep narrowing these down. I forget how much we started out with. Well, do you remember? But we're down to 4,055. Let's take
I think originally it was like 23,000
or something like, yeah, it was pretty high. So the theoretical win rate, I'm going to also maybe just put a floor and say historically 70%. So looking at it from a historical perspective, if we looked at a similar situation with the stock price, same distance away from the strike prices, same time, same amount of time to expiration, implied volatilities, similar, close to where they are. If we took a look at, if the stock doesn't have upcoming earnings, we took out that data with earnings. If it has earnings, we put it in. So we're running this theoretical model, and historically we want at least a 70% win rate, 5% theoretical edge. So I keep narrowing this down, 36.57. So I see that Apple's still coming up with a bunch of them. I'm going to go ahead and say, just show me the best per symbol, show me the best by some criteria. So here's show me best, and you have all these different options there. I'm going to do best by theoretical edge. All right, so now it's going to go scan through the markets in each of the symbols and pick out like best one in Apple, Microsoft, Alibaba, TSM. So you could see here in Apple, given all the criteria that we set. So based on all the filters we have, the best one by theoretical edge, May 20th expiration, selling the 128 put, buying the 126 put, 56-cent credit. We think it's worth 27 cents. That's a 19.8% theoretical edge. Historical probability of success, 83.3%. We got 2.1% downside cushion. And if the stock is flat or higher, 38.9% return. Microsoft, it's going May 21st expiration. That's looking at the selling the 247.5 put, buying the 245 put, 53-cent credit. We think it's worth 39 cents. That's a 7% theoretical edge. Historical probability of success, 82.1. That's a 2.2% cushion with a return if the stock is flat or higher, 26.9%. Let's do a couple more. Alibaba. Now that one has earnings estimated to report earnings in May 13th. So this May 14th expiration will cover that earnings. Okay, so if you're doing this, keep in mind that there's going to be an earnings event, and these options will cover that. So in our theoretical model, it is looking at historical return distributions around Alibaba's earnings. So it will switch to only look at periods where Alibaba reported earnings. But this is looking at the selling May 14th to 20 put, buying the 217.5 put, 61 cents. We think it's worth theoretically 31 cents. That's a 15.7% theoretical edge. Historical probability of success, 87.5%. It's got a 2.6% cushion to the downside. And your return, if the stock is flat, 32.3%. Okay, that's Alibaba. We got TSM, Visa. I'm going to just add another filter just to, try to narrow them down even further. We got 231. I'm going to go here to underlying stock ideas. And let's look for stocks that are just in an uptrend. So in other words, technically the stocks are moving higher this way. This will take out any stocks that potentially are just on a downtrend for some reason, because we just want to take a look at stocks in an uptrend behaving the same way as the rest of the market. So I'm going to look at stocks in an uptrend. So we've got it down to 106. All right. Let me see if I can narrow it down a little bit more. Let's look for stocks that are in an uptrend, and I'm also going to look for stocks that have bullish order flow. So this is looking at the option order flow. All right, so now I got it down to 52. Again, I could keep going, narrowing it down more and more, but let's see what else we got here. So Oracle, this is showing us June 4th, selling the 79.5 put, buying the 75 put, 89-cent credit. We think it's worth 15 cents. Again, theoretical edge, 20.6%. Theoretical win rate, 88.2. That's 2.3% cushion to the downside, and return to flat, 24.7%. Well, do we have any questions?
Well, we had questions actually on a stock that's reported earnings, so we can get to that tomorrow, SNDL, and also a stock that's split in CP. Now, everyone's enjoying this screen, D. They're really thankful for it.
Okay, awesome. So this lets me brush up a little bit. If there are questions, maybe we'll do another one tomorrow morning before the show. But again, I'll prepare a webinar for this tomorrow on interactive brokers. We'll be, talking to their community and going over some of these different analytics.
Yeah, I just put the registration for the link, everyone, back into the chat. So register for that webinar tomorrow. Also, Jake was on heavily today, giving some great advice as always. Anyone who's new, Jake started a Discord group. If you want access to that Discord group, just email me at williammcbride@gmail.com. And that's also been put in the chat a couple times. Great job, Dima.
Awesome. Thanks, everyone. Stay safe out there. Have a good trading day. I hope to see you guys tomorrow.